Welcome to the Tax Talk podcast. Home ownership can feel like a financial burden sometimes, but what if your mortgage could work for you, building wealth, saving tax, and accelerating payoff? Today, I am joined by Nick Cox, the National Director at the Smith Manoeuvre, to explore how Canadian homeowners can transform their mortgage into a tax-advantaged investment vehicle. Nick, I just want to say thanks for taking some time out of your busy schedule to hop on the podcast with me.
You're welcome, Jared. Thanks for having me.
Excellent. Really looking forward to this discussion. So today's problem, in Canada, unlike the U.S., homeowners cannot deduct mortgage insurance on their tax return, meaning most of us are paying with after-tax dollars to bring down that mortgage balance. With rising costs, heavy debt, and stagnant savings, many Canadians feel trapped in property rather than a wealth-building tool. So, what can we do about this? We brought Nick on to the podcast today to explore some alternative ideas on how to deal with this problem. So, first up, Nick, what is the Smith Manoeuvre?
Great question. You know, the Smith Manoeuvre, believe it or not, it's actually been around since 1984, but it wasn't until the early 2000s when Fraser Smith wrote the original classic, Is Your Mortgage Tax Deductible, that it kind of caught on like wildfire. At its core, the Smith Manoeuvre is a debt conversion process. It's the process of converting a non-deductible liability into a tax-deductible investment loan. And Fraser, you know, you mentioned that in America, our counterparts can deduct the interest against their personal income. Well, in Canada, you can't traditionally. So he came up with a method, which he obviously coined the Smith Manoeuvre. I like to refer to them as the 6 levers of debt conversion. Traditionally, it's known as the plain Jane, which is the foundational process of applying the Smith Manoeuvre. And then he laid on 5 accelerators, which are different ways to speed up the debt conversion process. So whenever I'm working with a client or teaching other professionals that work with clients, it's really about understanding that client situation to work out what's the most effective way to help that person convert that mortgage into a tax-deductible investment loan. And so, you know, our mortgages these days are for very large sums. And so creating this efficiency early on, the numbers are quite staggering over the long term.
Excellent. So you mentioned there's, I guess, an initial base aspect to it and then 5 accelerators as you kind of commented on them. So starting out, could you give us maybe just a brief explanation of what that initial process is in regards to the Smith Manoeuvre?
Yeah, so the best way to start is to start with what the plain Jane is. So I think we all know as we make our regular mortgage payments each month, that payment is comprised of principal and interest. The bank keeps the interest cost and the principal reduces the balance.
Right.
That's what allows you to pay your mortgage off over time. One of the things that allows the Smith Manoeuvre to function is that in Canada we have what's called a re-advanceable home equity line of credit. And this is basically called a HELOC for short, a HELOC that's attached to your mortgage. And as you pay down the principal, the available credit on the line of credit increases. And so your available credit limit is actually always the same. And as we pay down the debt, the available credit to borrow is made available. And the process of the plain Jane is as you pay down that debt each month, we re-borrow the principal that's re-advanced into the HELOC and invest it. And you're an accountant, so as long as we invest with the reasonable expectation of generating income, then the interest costs on that line of credit are tax deductible. And so 2 things happen here. First of all, we've instantly created a deductible expense. So at the end of the year, the Canadian is going to be able to deduct that against their personal income. And so that's either going to create a refund or a reduction in their tax liability. And the first part is when we take that annual saving and we apply it as an annual prepayment against the primary residence mortgage. That will create and open up more room in the HELOC. We re-borrow that and invest. And the second thing that's happening is that we're instantly putting the principal reduction to work by investing in an asset that ideally is going to, A, produce income and 2, going to grow over time. So there's no debt equity in the property. This is where there's kind of a bit of a conundrum, right? Technically, it's a debt conversion process because you're not increasing the debt, but it's also technically leveraged because you're borrowing from a line of credit. So what really happens is we're not increasing the debt 1 cent above the original mortgage balance. We're just ensuring that as we pay down that debt, we're repurposing it to an investment that's going to grow. And I think one of the things that really attracted me to this is that the whole process, and what I've just described is the plain Jane, it can be implemented with no additional cash input. So a Canadian can make their regular mortgage payments and not pay a cent above their regular mortgage payments, yet they can create increasing tax deductions, increasing refunds, and create an investment portfolio by repurposing their principal reduction. This produces, if you get someone early on when they've just got their 25 and 30-year amortization mortgage, based on the average mortgage balances, this works out to hundreds of thousands of dollars of savings over the lifetime. Like, they're not small numbers.
No, that's really interesting. It's always important to kind of keep your mind open to ways to make that debt useful to you. Yeah, I mean, it's important to, get a home and kind of be secure in that sense. But, typically speaking, it's just kind of debt that sits there. And like you say, prices keep going up. Those mortgage balances, when you're taking on that 25 or 30-year mortgage, they're quite significant, probably especially in some of the bigger cities across Canada now. So it may not be feasible for a lot of people just to keep that debt on the books for 25, 30 years there. So if you can make some of these maneuvers, and by your description, it doesn't sound like it's, with respect to the plain Jane process, it's not overly complex. It's not like you need to hire a whole team of, tax accountants and lawyers and stuff to implement this. Yeah. This is just more kind of a savings program that you can effectively implement in large part by yourself. Would that kind of be an accurate way to describe it?
Look, I think if I would always advocate for it to have at least one professional in your corner that really deeply understands the strategy. Okay. On the surface, it's simple, but there's a lot of complexity contained within that simplicity, and each person has a very individual, scenario, and that might impact the way that it's going to be employed. I think one really important point to note is that it's very rare to be able to create an output without an input. And what I mean by that is, if you're a Canadian and you're wanting to save for your future and you go see a financial planner, there needs to be a delta between your net income and your expenses in order to save, right? To make a contribution to an RSP or to a TFSA or to a non-registered portfolio. Canadians, like Australians, the accent, we're obsessed with real estate, and real estate prices are high, our mortgages are high, and they're taking a high disposable percentage of our income. So savings are actually dwindling, but the Smith Manoeuvre, I think, again, I love the subtle beauty of it, that it's creating an efficiency within an existing structure that doesn't require additional cash inputs, but produces greater savings. And that's quite rare. And so you speak to a lot of people have heard about the Smith Manoeuvre, but then when I dig a bit deeper and I say, tell me what you know about it, there's only generally a surface level understanding. And so I think with how challenging it is just to make ends meet, anything that we can do to get ahead financially, it doesn't require us to earn more money, is something worth looking at. And yeah, can you do it yourself? Yes, but just make sure you got at least one person that's in your corner that knows what they're doing. And that's why we have the Smith Manoeuvre Certified Professional Network.
And that's a good point. I would agree with you 100%. I mean, there's probably a lot of people that could do the bookkeeping or the accounting themselves, or can do some of the legal aspects of running a business themselves, but why not get a professional in your corner, someone that has some experience in that field, similar to the Smith Manoeuvre, to make sure that when you're implementing something, you've got somebody that has a little bit of history and some knowledge on it to ensure that you're implementing it correctly. Because I would presume, you would need to put the funds that you're kind of gleaming off into an investment account that would be a non-registered account. Is that correct?
Correct. Yeah.
Because basically, if you were putting the funds into a registered account, then the interest does not become tax deductible. So again, you could set up this all on your own, not knowing that, the funds that you're putting into the RSP and, paying balances on this HELOC then become not tax deductible come tax season. So important to kind of understand some of the differences in the investment accounts.
Yeah, really important. I mean, the TFSA, the RSP, they've got their own funds. They're kind of silos. They have their own tax treatment, and so they're not to be commingled with the Smith Manoeuvre. It's really, like you said, it's just the two things that are kind of the really important ones to remember is that it must be a non-registered investment, and it must produce income or have the reasonable expectation of it. you can't go buying crypto or gold, right? There's no reasonable expectation of them producing income. So
Right.
that's kind of like your broad kind of goalpost of making sure that you meet that requirement. Then the other thing though is, could I do my own taxes? Could I do my own legal work and contracts? Like maybe, but I would much rather engage an accountant like you who knows what they're doing at their craft, right? So I think having some professional guidance, unless you're really dialed in, is really important. Also to help you stay on track. Yeah.
No, that's excellent. And I think the point that you raised earlier in regards to, you don't have to have any additional cash outputs to do this savings, because I would agree with you. I mean, the ability for people to save these days becomes harder and harder. You got a good chunk of your, gross check going over to pay the debt on the house. You got a significant portion going to income taxes these days. Food prices go up. So I find a lot of people, they can save within a particular structure. And if you're not taking anything further off the top from them, you're not making them, cut back on lifestyle aspects, because, the lifestyle creep is a big factor that plays into it. As that income goes up, well, then all the expenses associated with it, I need a bigger vehicle and I need longer vacations, et cetera, et cetera. So if you can find a way to work this savings plan amongst what you're already doing, I think that would be probably a little bit more feasible for the general Canadian.
Right? You mean I'm able to save money and it doesn't cost me anything?
Exactly.
Right. That just that in and of itself is quite a remarkable thing. Like it really. I always wanted to be a financial planner, and I think that maybe that's why I worked in that field. But I was always a better mortgage broker than I ever was a financial planner, and I think that's possibly why I gravitated towards the Smith Manoeuvre so much, because it's this financial strategy that really bridges three disciplines. This is very much a tax strategy. It's solid financial planning, but it has to be executed through a mortgage plan. Right. And so you've kind of got these three different disciplines that come in, that have elements of the strategy. And for context, can I just tell a little bit of the reason? So Rob Smith, Can I tell a little bit of a side story? So
for sure.
Fraser Smith came out with this strategy in 1984, where he did it for just in his own practice until the early 2000s. He wrote that first book and it caught on like wildfire. It actually had a really steep trajectory within the financial planning space up until the global financial crisis. After the GFC, leverage became somewhat of a dirty word from a regulatory and compliance perspective in the financial planning industry. So it fell kind of out of favor with the broader financial planning group, but it still maintained its trajectory and it was very, very popular. Now, Rob Smith kind of came in and ran the business with his father. So the two of them were managing quite a large book. They had hundreds of clients, very significant volume in assets under management. But after Fraser passed and Rob was running the business for a few years, he didn't have any time to really get out there because you're managing a business. So he felt inspired to rewrite his dad's book. There's a new updated version called Master Your Mortgage for Financial Freedom. And he wanted to create a network of professionals that were properly and deeply educated on the Smith Manoeuvre, because a little bit of information is dangerous. And whilst a lot of people say, oh yeah, the Smith Manoeuvre, they leave in a lot of financial professionals or ask them how it works, and they get very basic things wrong. And so Rob kind of rewrote the book, created an advanced course, and we currently have 7 different professional classifications that have the SMCP designation. And look, the designation is not supposed to carry the weight of a CPA or a CFP. That's not what it's about. It's really just about identifying a professional, whether that's a mortgage broker, investment advisor, planner, insurance advisor, accountant, lawyer, or realtor, that really deeply understands the strategy and can guide their clients on the execution. And so, ironically, I've forgotten the context of why I started that story, but I wanted to give you a little bit of a backstory of like where the Smith Manoeuvre started from, what the Smith Manoeuvre Services Corporation is all about. And it's really just about empowering professionals so that we can continue to help Canadians. And ironically, even though this strategy is 40 years old, I'd say it's probably more relevant now than it ever has been, based on just the economic climate and the relevance of finding every efficiency we can to get ahead financially.
Yeah, I appreciate that. I mean, a good backstory to explain what it is that this, strategy is trying to accomplish, and the people behind it is always nice to know. And I would agree with you, if you're looking for someone to, potentially explore this option for yourself, why not find someone that has done some training and it has some experience in it, as opposed to, just winging it or, getting some advice from, Joe Blow accountant that is, heard of it, but doesn't really actually, have the history to kind of walk you through it to make sure it's working in your best interest.
The devil's in the details. When I was speaking to an engineer yesterday who I got on the phone with him, and he just had a couple of questions. This guy, he read engineers are detail oriented. He read the book. He understood everything, but there was a few things that's like, yeah, but how do I do this? And I just gave him the information. I'm like, he's definitely a self-doer. He will go away and he'll manage it himself, but he spent a lot of time working out the details and just needed a little bit of help. Yeah, but continue on. I keep taking stuff on tangents.
No. Tangents are good. So I have a little bit of a tangent here. So a question's kind of popped up on me. So I'm guessing you've heard this when you maybe first sit down and chat with someone. So I understand the premise of how this kind of works. Instead of me just paying off the mortgage directly, I'm moving some funds over, paying off this HELOC. Now, I'm investing into a non-registered account. That's obviously going to accrue in value. I'm going to see some, dividends or some interest come back from that on a regular basis. What are people's concerns, if any, in regards to that HELOC debt that they're holding? Does that become a concern? And how do you kind of deal with that as you first get them into it? And what does that look like long term?
Yeah. So the idea, because you're right, sometimes people have an aversion to debt. But it's really important for us to have a deeper understanding of what debt really is. The wealthy understand that debt can be utilized in ways that helps them get ahead. But for most Canadians, we don't want to have debt. But there's a big difference between good debt and bad debt that is non-tax deductible and debt that's tax deductible. And so when I go through an analysis for the client, and we've got there's a really robust proprietary calculator that only Smith Manoeuvre professionals have, and it allows you to really quite finitely project out how the Smith Manoeuvre will unfold based on the individual circumstances. I like to show clients 2 points. Well, actually, there's kind of 3 points. The first one is I show the client the debt conversion point. So the point, and I'm getting to your question in a roundabout way. There's three distinct things that I want the client to understand. The first is, what is the point at which the non-deductible mortgage has been converted to a tax-deductible investment loan and that the debt is fully deductible? So we're able to show the clients the total tax deductions and the total tax refunds achieved over a period of time. The next thing I like to show is what I call the theoretical mortgage freedom date. And so this directly addresses your question of the concern around increase, kind of having your debt go sideways, never paying it off. But that debt is secured by an investment that ideally is that's going up in value more. Mm-hmm. The mortgage freedom date is this theoretical point in the future when the value of the investment portfolio is worth equal to or greater than the remaining debt. And so this calculator allows me to pinpoint a point in the future where, based on client's marginal tax rate and the projected return, when they could theoretically sell the investment portfolio and use the net proceeds to pay out the debt. Based on I know, it varies based on client, but generally speaking, 4 to 8 years off your amortization, you would be able to take where the underlying portfolio is worth more than the outstanding debt. And so what I like about that is that sometimes a client might be like, I just want to use this because I want to be debt-free as soon as possible. Mm-hmm. So we can actually use the Smith Manoeuvre to create a portfolio over a period of time and then use that to pay down the debt. So I like to show the mortgage freedom date. But we also know that compound interest is our best friend, and it kind of kicks into gear a little bit further on. So when someone's bought a property, they're kind of committing to a 25, 30-year amortization on their mortgage. So I say, let's do an apples for apples comparison. Option A, you just pay your mortgage off the traditional way. In year 30, you've got a property with no debt. Mm-hmm. Versus the Smith Manoeuvre, you still make the same amount of mortgage payments over the 30 years, but in year 30, you've got the property, you've still got the debt, but you've got a massive portfolio that's worth substantially, ideally over 30 years, it's worth substantially more than the debt. And so at that point in time, the client's got a lot of options, right? They can continue on with the tax-deductible investment loan and this massive portfolio, or they can liquidate the portion of the portfolio required to pay down the debt. I'm not sure if this does specifically address some of the core points. The truth is, I even speak with a lot of investment professionals that really hate the idea of leverage, and they don't like that you're not paying your debt over time. But when you look at the numbers, it just makes sense. If you can you're a tax guy. Like if you can borrow money at 5 or 6% and you get 50% of that back as a tax deduction, and you can invest with an 8% yield, if you can, your net cost of borrowing is what, 3-4%, you're earning 8, like that's a good investment. So I think a part of it is educating clients on getting comfortable with good debt, getting rid of bad debt. But it is a sticking point for some people because they find it hard, the concept of like, I just want to be debt free. I don't know if that properly answered your question, but it's a tough one, and it boils down to the psyche of people and how they approach money at a much deeper level.
No, that perfectly explains it for me. I completely understand. So, yeah, I mean, more often than not, clients will come into my office. Maybe we're sitting down to go over the financial statements or something like that. And they're asking, what should they do with this, that, and the other thing going forward? Yep. And a lot of times that'll be a conversation that comes up. I've got some debt on the books. What should I do with it? Well, I would completely agree with you. There's good debt and there's bad debt. I mean, just simply put, if you're carrying a whole pile of credit card debt at 20% versus you've got some sort of term loan for a vehicle that you got in your business that you're paying even 5-6%, well, if you got some extra cash flow, let's put it towards that credit card balance. And it similarly applies here, just on a bit of a different scope and a slightly different topic. But I would agree, if you can get it to the point where you can get some tax deductible interest, so you're getting a bit of a write-off there, and you can get some sort of decent return over the long run. And I would think that this is definitely something that you're going to commit to long-term, because if you're putting, if you're putting some funds into the market for, 2 years and you want to just tempt this out, well, we've all seen what has happened over the past, 6-7 months or whatever in regards to tariffs. If you're buying here, selling 2 months later, you're probably going to lose your shirt here pretty quickly. But generally speaking, if you put your funds into the market and you leave them there for the long term, the market just goes up. That's the way things eventually work. So long-term planning, I think this would make some sense for some people.
Yeah, it's not a short-term strategy. You got to be looking. I mean, if your time horizon is anything less than like 10 years, you're really not wanting to look at it. It's probably not an appropriate strategy. I would suggest when you get into a mortgage, that mortgage is for a long period. I think so many, whether it's a banker or a broker, we're so focused on helping the client get approved and to purchase a property. But what's really missing is the relevance that mortgage has in that consumer's financial life, that accounting, financial planning, and mortgage broking hasn't really kept pace of, hasn't really kept track of in the context of how much all these expenses have increased over time. But you're 100% right that it has to be done with a long-term mindset. I also wanted to just circle back a little bit, because when you asked me the question to explain the Smith Manoeuvre, I didn't actually touch on the 5 accelerators. I don't want to go too deep, but I'll give you a couple of examples. The plain Jane, which in and of itself, which is just that, someone's got a primary residence and they're just going to pay their debt off over time. And as they pay it off, it re-advances in a line of credit and we invest it. Mm-hmm. The 5 other accelerators is called the debt swap, the cash flow diversion, the cash flow dam, the DRIP, which is the dividend reinvestment plan, and the prime the pump accelerator. And I'll just very briefly just explain it because it might be relevant to you and some of your audience. Sure. A debt swap is where someone might have a non-registered portfolio, say $100,000. I'll give you an example. This is a really powerful version of the debt conversion method. Let's say someone has a $500,000 mortgage and they've got a $100,000 non-registered investment portfolio. So the way the debt swap works is they would theoretically sell the investment portfolio, free up the $100,000, prepay the mortgage, reducing it from $500 to $400. Provided they got the re-advancing line of credit, they would re-borrow the $100,000 and invest it in a similar asset that produces income. They'd end up in the same place they started, $500,000 worth of mortgage debt, $100,000 worth of investment, but they've instantly created a $100,000 tax deduction. And so the effect that has on tax refunds and sort of jump-starting the plan is quite considerable. I can just see myself getting into the weeds here, so I'm going to back up and make sure that I don't. But one that's going to be really relevant for a lot of Canadians is the cash flow dam, and that's if you're a Canadian that owns at least one rental property that's producing income in your personal name and you've got debt on a primary residence and you're not doing this, stop right away and you need to really consider it. The cool thing is you can isolate any of these 6 levers and use them in isolation. You don't have to do the plain Jane. You can just go and do the cash flow dam. And if you have a client in front of you that's got a rental portfolio, I often ask them, I say, hey, which of these versions are you doing? Oftentimes they get the rental income. it goes into an account they specifically set up for the rental property, and they pay the expenses. Or the rental income comes into a general account, gets mixed up with everything else, and they pay for it, and they leave it to you to work out the deductions at the end of the year.
Sure.
But there's a massive missed opportunity there. One of the best ways to structure a rental property portfolio, when you get that rental income, would you agree that provided the rental property is owned in personal names, that rental income, you can do whatever you want with it. It's your money. So the rental income, we don't use it to pay the rental expenses. We apply it as a prepayment on the primary residence mortgage. This is generally going to be thousands of dollars because it's a rental property. That creates substantial room in the line of credit because a full dollar for dollar of the principal reduction re-advances. We re-borrow the rental expenses from the line of credit to service the rental property because that rental property has the reasonable expectation of generating income. I can often show clients how to pay their mortgage off in 5 to 7 years instead of 30. Now, I should caveat, that's the debt conversion point, right? You can pay your mortgage to zero and replace it with a tax-deductible investment loan, but that single maneuver saves people like 5, 10, 15 years off their amortization, and I'm not joking. I think one of the remarkable opportunities there is like you can walk past 100 investors, 99 of them aren't doing it, but 100% should be. And so I do find it odd that this remarkable strategy that's just kind of been simmering under the surface and it just hasn't got that mass awareness.
Yeah, that's a real interesting point because I know over the last couple of years, especially, more and more clients seem to be getting into that rental space. And I think it's just basically boiled down to the fact that, there's been additional opportunities in respect to Airbnb and things of that nature. And there just seems to be this buzz about, getting into the real estate game. And, people are always coming in and saying, what can I do? What can I deduct? How can I lower my taxes on this? So there's another way that definitely is probably news to me for sure that could be beneficial to some certain rental property owners to look at it another way to reduce some of that overall cost of borrowing on that principal residence and kind of build that overall portfolio as a result.
Yeah. I won't go into the weeds on the other ones because I could just see myself getting way too deep. What I would suggest is, honestly, for any listeners that are like, this is really interesting, go and grab one of those books, How to Make Your Mortgage Tax Deductible or Master Your Mortgage and Financial Freedom. It gets really into the weeds there, but I'll hand it back over to you for your next question, buddy.
No, sounds good. So we've already touched on the fact that this needs to be more of a long-term play. What are some other kind of characteristics, I guess, that you might want to see out of a particular client who's maybe going to be a good suit for taking this into their overall plan?
Really great question. Because even though someone might have the specific makeup and the scenario that it would just suit really well, there's got to be a filter system or a check with the professional. Does this client have the mental bandwidth to do this? Do they have, I remember when I first started doing this, I was so excited that I could almost hear the client's eyes blazing over the phone. And, they're like, what is this guy talking to me about taxes and wealth building? Man, I just want to buy a house, right? So we've really got to be mindful of who we introduce to the strategy and whether we think the client has the bandwidth to do it. Things that I always look out for is like, when you look at a client, as someone, I'm not really actively mortgage broker myself anymore, but as a mortgage broker, like we're looking at the credit bureaus, we're talking to the clients. If you've got a client that's got lower credit scores and they've got debts all over the place, like that is not generally a good person to speak to the Smith Manoeuvre on. If they've got a higher credit score, like they're paying their debts off each month, they're kind of, they're interested in getting ahead financially and growing for the future. I love working with, young families, right? Married couples with young kids kind of just getting going. So I think, I hate to say, like people that are organized, want to get ahead, have the bandwidth. And what I actually did, Jared, I after working out the hard way that I can't just start telling everyone about this, I created a simple process, which is I say to the client, hey, Jared, we're going to have two conversations. The first is about your objective, right? Purchase, refinance, renew. The second is about looking optically at your mortgage as a financial planning tool and the relevance it has in your long-term plan, specifically addressing interest, taxation, and wealth building. Are you open to having a conversation around a longer-term plan, or would you just like to have, just want to get this transaction done kind of thing? And I paraphrase that, but I think when you candidly and genuinely offer the client the ability to have a deeper planning conversation around their mortgage, my experience is not a single person says no.
And that makes sense. I think everybody's going to have a different appetite for everything. And I mean, generally speaking, when clients come into me and they're asking me about various different, plans and strategies that I have, generally speaking, in my, experience, simple is best. So if you can easily understand what's going on and you can, follow through on this on a regular basis, it's probably something that's going to work for you. There's no sense in my mind in making something too complex, i.e. you hear about this and you decide you want to put in the plain Jane and you want to do all 5 of the different accelerators on your own and you make things unneedlessly complex. Why not talk to someone that has some experience in this, field, and you get an idea as to, okay, this is my situation. Maybe this version of the maneuver is going to work for me. I can see me doing this quite simply. I can carry it through. I've got the long-term, understanding of where this is going to take me, and you can kind of work with a client based off of that understanding.
Yeah. And I think, it's important to recognize that the opportunity for this to be increased, like you have those clients that just research it themselves and they're like, I want to do this. But generally speaking, like accountants, you guys are so busy and you've got that tax time sort of period. The accounting model at large isn't really set up for at scale to be able to support consumers like with everything they need with the Smith Manoeuvre. So it hasn't, like there's other accountants out there that kind of specialize in it, sure. But generally speaking, it hasn't got that mass awareness and implementation, even though there's that tax element strategy. The unfortunate truth is a lot of financial planners are kind of handcuffed, but depending on if the MFDA, IROC or exempt market dealer, whatever their licensing is, will determine, and their own comfort level, whether they want to lean into that. And then mortgage brokers are traditionally loan officers. So you've kind of got, I think that in that is kind of a part of the reason why it hasn't got deeper traction, because none of the independent professional classifications have really run with it. And I think that's why it's important. Like, again, we're not, there's only going to be 1,000 Smith Manoeuvre professionals across the country. And the reason that's important is it's just a way to make sure that Canadians are going to either an accountant or a financial planner or a mortgage broker that has decided like, hey, I actually want this to be a core part of my business. Does that make sense? Like it's this weird, that's how I think it's kind of been this remarkable strategy that's just been simmering under the surface, because there hasn't been a holistically integrated body that has been able to really deliver it to the Canadians at large.
No, and I completely understand that. And I think where I maybe see how that's kind of transpired is, I guess from my perspective, a good chunk of what I do is tax compliance. You're basically, in a lot of ways, required to come see me at least once a year to fill out some forms and send them into the government. Otherwise, the government gives you some sort of hassle. Investment brokers, they make their money based off of selling investment products to you. Whereas this Smith Manoeuvre, there really isn't that same kind of forcing the client into it. So it's something that you can get the advice on, you can implement it, but no one's, being made richer off of the fact that this is being mandated by the government or whatever the case might be. So I think that probably plays into it to a certain extent. It's a useful tool, but no one's kind of driving it down your throat. So as a result, it maybe doesn't get the same notoriety as some of these other things do.
Yeah. That's why I think I feel it's a great opportunity for the professionals that are naturally inclined to it. Because I find like some people like, wow, this is, what the most common reaction I get from clients is, and even just some professionals, like I remember my financial planners, I've done a lot of work with financial planners in my mortgage business. And the one that I would do the most work with, I keep telling him about the Smith Manoeuvre. He's like, yeah. But then I posted it in the book and he finally read it. He says like, I read it in the weekend. He's like, oh my God, it's so obvious. He's like, I can't believe I haven't been doing this for the last 10 years. And that's actually the most common reaction when the light bulb goes on and someone's like, hang on a second. You mean to tell me I'm 15 years into my mortgage and I could have been doing this for the whole time? Right. That's actually the most common reaction. And so that's why I feel like I never would try to say, I would never introduce it to consumers from the perspective of just trying to sell them on something. I actually feel like I have a fiduciary responsibility. If I don't tell you about something, you're saying no without actually being given the option. So I feel like if I know that there's something that's of value to you, like my responsibility is like, hey, this is here, this is how it works, and it's available to you. It's completely up to you if you do it. Very quick story, Jared. The same financial planner, we do a lot of work together or have done, and I help him and a lot of his clients with the strategy. Refers me a client, and he specifically says, do not mention the Smith Manoeuvre to this client, right? Because the client's in his mid-50s, he didn't think it was relevant. I'll be honest, I totally forgot. And so because my process is to have the conversation with everyone.
Sure.
Spoke to the client. He's like, how am I not, absolutely loves it. Fast forward 6 months, he's doing like 4 versions of the Smith Manoeuvre, and it's completely changed his financial plan. So I think we should never second guess who we should have the conversation with, because you never know who it could. Some people don't like it, others absolutely love it.
And that's a good point. I think as professionals, a lot of times I just kind of come from the approach that everything I know is general public's knowledge. But when you sit back and think about it, the things that I know, probably not a whole lot of people know. So just having these conversations, what can it hurt? I mean, knowledge is power. The more you know, probably the better off you're going to be. And it's completely up to you as to what you do. And again, I'm coming from an impartial point of view. I'm not trying to sell you on anything. And as a result, if you're better off as a result of implementing something that you gain some knowledge about through initially speaking to me, I think I've probably done you a service in that regard. So,
yeah. I mean, empowering people with the education and just the option of knowing what's available and giving them the completely up to the individual or professional if it's a path they want to go down, but making sure that people are aware of that it's there. Yeah.
For sure. So I don't want to necessarily end on a sour note, so I want to hit on the next one real quick. So like anything in life, there's going to be some risks or some considerations that you've got to take into consideration. What are some of those real quick? And then I want to hit on some of the positives just to refresh, and then we'll close this thing out.
Oh, yeah, definitely. So it's really important, like properly executed, any risk can be mitigated, but let's look at them. So implementation risk is a big one. So there's a very specific process that someone would need to go through in order to operate the Smith Manoeuvre, any of those 6 levers in the different combinations. And if someone's commingling funds and not following the process, then that could have them fall foul with their accountant and CRA, and the CRA could come in, maybe they do an audit years later and they go, hang on a second, you've not done this correctly, you can't claim all these deductions. So implementation risk is a very real risk. That can be mitigated by just making sure that you're working with at least one professional who really understands the strategy and that everything's properly documented. And so, again, is it risky on the implementation side? Yes, but it can be mitigated with proper advice. The next one, like I'd say the 3 main ones is implementation risk, market risk, and liquidity risk. And so I'll break those down.
Sure.
Market risk is like the fluctuating underlying asset. What if the investment that I invest in goes down in value? Well, like you illustrated, if we invest for the long term, it's fairly likely that long term it's going to go up in value. But what if something happens in our life and we need to sell and reverse out the strategy in a market downturn? That's a real risk, right? But is it any? So you can compound your losses if you're having to exit at an inopportune time. I think that happened to a lot of people in the global financial crisis. Right. But the truth is, your other investments would have taken a hit too. So as long as you go in with understanding that this is a long-term strategy, and hopefully you're not put in a position where you have to liquidate at an inopportune time, that would be a risk because you are still technically using leverage. So that would compound your losses there. But I feel like that can be mitigated with proper planning as well. And then liquidation risk is like, there are some investments that only allow you to sell out once a year, right? Or you might have a property that doesn't sell. So the period of time that it takes to liquidate an asset. I feel like most risks can fall under implementation, market, or liquidity. Off the top of my head, I can't think of anything else that would apply. But I would just say, the importance of just have at least one person in your corner that really understands it and that you're documenting everything correctly.
Excellent. No, I think that's a good summary. And like anything, everything comes with some risks, but if you take the proper steps, you can do things to mitigate that. And having a good understanding and a good professional in your corner is going to be a good way to mitigate that as well. So before we close, top 3 benefits of the Smith Manoeuvre in your opinion. What do you think?
Top 3 benefits. Okay. Create additional wealth that didn't cost you anything. You can create more wealth without putting any money in. That's huge. Maybe it should be like, that's 1. 2, I love that we're taking money back from the banks and the government. Maybe it should be called the Robin Hood maneuver. We're literally creating tax efficiency. So we're getting, the CRA is sponsoring this. We're getting increasing tax deductions that are free from the government to the government where we pay a lot of taxes, we pay a lot of interest. So I love the fact that where banks and governments, they have a lot of money, right? So let's keep that in our back pocket. I love that. The third one, 3. I think just the subtle beauty of it, that it's a self-funding mechanism.
Sure.
You know, I didn't give you guys the secret sauce of how you actually make this a self-funding mechanism, and I'm not going to give it to you. But the fact that you can do this without any additional cash inputs, and you use the increase in efficiency of the primary residence mortgage. We're not going to go down that rabbit hole, but sure. The fact that it's a self-funding strategy, which I guess is kind of maybe like 0.1, but they're my 3 that I didn't have prepped. Probably should have prepped those.
No, that's good. I like that. Keep them coming back for more. So just to kind of recap, so if you are a homeowner looking to accelerate wealth, what are some next steps that you can kind of take in this process? Well, one of which, subscribe to this podcast, whether it's on YouTube, Spotify, whatever the case is. Give us a like, subscribe. That'll help to get the message out and keep you in the loop for upcoming materials. Number 2, if you're on YouTube, share some questions. I'm sure Nick would be happy to touch base with you, answer some of those questions. And number 3, reach out to smithman.ca, connect with Nick personally, and get a little bit more information as to what this potential maneuver can do for you. So, Nick, if people want to get a hold of you, what is the best way for them to do that?
Yeah, so I would say if you're a professional listening to this podcast, and so you're one of the following 7, accountant, realtor, lawyer, insurance investment, financial planner, or a mortgage broker, then reach out to me. My email is simply nick@smithman.ca because I work with professionals. But if you're a consumer, if you're a Canadian, it's like, wow, I really want to implement the Smith Manoeuvre, literally just go to smithman.ca and there's actually a link where you can say, hey, I want to be connected to a Smith Manoeuvre professional. And then based on the professional you're looking for and your geographical location, you'll be connected with a licensed professional that can help. That's the best way for consumers because I don't do the client work myself anymore.
Excellent. No, that's perfect. So I just want to say thanks again, Nick, for taking some time out of your busy schedule to chat. I thoroughly enjoyed this conversation. I knew a little bit going in, but have definitely learned a lot from chatting with you over the past little bit. So thanks again.
Jared, I really appreciate you having me on. Thanks so much.
Excellent. So for the Tax Talk Podcast, I am Jared Plon. Thanks again for listening. Take care, and we will talk again soon.